Hi there, folks. It's Clinton Donnelly, and today we're going to talk about the government's Operation Choke Point and how the IRS may get involved. Folks, we're going to talk about crypto regulation. You know what's been going on with the Biden executive order on regulating cryptocurrencies? A whole lot of nothing, that's what. 6 months ago, Secretary Yellen promised recommendations on regulating crypto, but we still haven't seen anything. What we have seen is enforcement. Enforcement by SEC Chairman Gary Gensler. He's going after crypto exchanges left and right, all under the guise of enforcing securities law on cryptocurrency. And let's not forget about the Federal Reserve closing down crypto-friendly banks. It's starting to look like Operation Choke Point, folks. But wait, it gets worse. What if the IRS decides to treat cryptocurrencies as securities under tax law? That's right, I said it. The IRS hasn't done it yet, but they could. And if they did, it would be devastating for crypto investors. The term security may not be defined in income tax law per se, but it's frequently used, and it's closely aligned with the definition of stocks and stock rights. Stocks give you ownership of a corporation and a say in how it's run. If the IRS treated cryptos as securities, it would mean more taxes and more regulation for security investors. So is this all part of a larger plan to kill off crypto investing in America? I don't know, but it's starting to look like it. Instead of getting the promised regulations, we're getting choke point. The SEC is leading the charge, and now the IRS could be next. This is a dangerous game they're playing, folks, and it's time to stand up for our crypto rights before it's too late. You see, the government has been trying to figure out how to regulate cryptocurrencies for a while now, and while we haven't seen any substantive concrete regulations yet, the IRS might be looking to make a move soon. All they need to do is announce that they will treat crypto investing the same as stock investing. Stocks represent ownership in a corporation. Now you might be thinking, how can cryptocurrencies even be considered corporations? Well, the organizational structure of a blockchain is called a distributed autonomous organization, or a DAO. And while DAOs are unincorporated, they do operate like a corporation in important ways. Ownership of tokens grants some say over governance and rewards. In tax law, a DAO is considered an association. An association is a group of persons working together for a common purpose. So, according to Section 7701 of the Tax Code, associations are considered corporations and taxed like corporations under current tax law. This means crypto investing could be taxed like stocks. And if the IRS does assert this argument, it would be consistent with the SEC and existing tax law. So let's tease out some of the implications. Let's look at a couple: wash sales, PFICs, and foreign asset reporting. If crypto investing is taxed like stocks, the wash sale rule is applied from Section 1091. And what's the wash sale rule, you might ask? Well, you sell a certain crypto for a loss and then buy it back within 30 days before or after the sale. You can't claim that loss on your tax return. And here's the thing. This would devastate high-frequency traders who are constantly in and out of the same crypto. To avoid the wash sale rule, they need to get active trader status, which is tough to qualify for and sustain. So let's talk about the PFIC rule. PFIC stands for Passive Foreign Investment Corporation. And since a DAO would be considered a corporation under tax law, and since no DAOs are incorporated under U.S. laws, DAOs are considered foreign corporations. If 75% or more of the DAO's income is from passive sources, or if 50% or more of the assets generate passive income, it would be considered a passive foreign investment corporation, or a PFIC. And since all DAO income is passive, all DAOs would qualify as PFICs, including Bitcoin. Here's where it gets tricky. The PFICs tax is brutal, folks, and it can be 40 to 60% of your investment profits. And if you live in a high income tax state like California, the combined tax could exceed 70%. Congress pushed the PFIC laws to punish taxpayers who invested in foreign mutual funds and to keep Americans investing in U.S.-based mutual funds. And it worked. But the PFIC tax rules are complicated to calculate and require special software. If the IRS applied the 40 to 60% PFIC tax to crypto investing, it would be crushing. Investors might stop trading cryptos or stop reporting their crypto income on their tax returns, which is tax fraud. The only way to avoid the PFIC tax is to show that all the owners of a particular DAO, that not all of them have limited liability. If that can be shown, it would prevent the DAO from being treated as a corporation. But here's the thing, folks. Could the IRS be playing a role in Operation Choke Point? It's worth considering. If cryptos are taxed like stocks, we're going to need to start reporting foreign financial assets. And that's where things get complicated. Under the FATCA law in Tax Code Section 6038D B2A, we're required to report any stock or security issued by a person other than a United States person. Now, almost all DAOs would be non-U.S. And let me tell you, FATCA is a law passed back in 2010, and it's no joke. Taxpayers must report certain foreign financial assets on Form 8938 if the value combined is over a threshold of $50,000 per person. Now, don't get me wrong. There's no tax associated with Form 8938. But if you fail to file it when you should have, you're in for a world of hurt. You could face a $10,000 penalty just for not filing it with your original return. But that's not all. The statute of limitations on your return is suspended until you file Form 8938, plus any additional tax related to assets that should have been reported on Form 8938 is subject to a higher 40% accuracy penalty. That's right, a 40% accuracy penalty. And let me tell you, the greatest risk for early crypto investors is having the statute of limitations suspended. But don't worry, there's a solution. You can amend your past returns to add Form 8938 using the IRS Delinquent International Information Return Procedure for voluntary disclosure. But here's the thing, very few taxpayers even know about Form 8938 or the procedure. And for many, the form isn't even supported in their tax software. This makes the unwary crypto investor very vulnerable. So what's the deal with the IRS? Will they follow the SEC's lead? Will they have a role in Operation Choke Point? Well, here's the thing. The laws are already in place for the IRS to treat cryptos as stocks. All they need to do is issue a public notice and give an obligatory 3 months for public comment. And get this, enforcement could even be retroactive. That's a massive risk for investors. If the IRS decides to treat crypto investing the same as securities, the consequences could be devastating. We just looked at 3 issues: wash sales, PFIC treatment, and foreign asset reporting. And let me tell you, there are other consequences if we explore the taxation of futures, options, securities, and derivatives. And here's the kicker. Other countries may follow the U.S. lead in taxing cryptos as securities. So, to sum it up, we're in some unusual times, folks. And if you're not careful, you could be in for a world of hurt when it comes to taxes and cryptos. If you need help on your planning, please give our office a call. And let me know your thoughts on Twitter and reference my handle, CryptoTaxFixer. Let me know your thoughts about this show. And if you enjoyed this podcast, make sure to like and subscribe on YouTube and share it with others. All my best, Clinton. Taxes are sexy.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive audit defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like audit defense membership. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.